Thank you very much for that nice introduction. Happy to be here in London at my age, and happy to be anywhere. You know, it's funny, I've been doing this a long time. I won't tell you how long, but many of you weren't alive when I started. But I started technical analysis first in stocks, and I went to commodities, and I went back to stocks. And I'd say the first 10, 20 years of my career, very traditional technical analysis. You know, the kind that you learned in Edwards and McGee and that type of stuff. And I wrote a book about, I don't know how long ago now, maybe 30 years ago, Technical Analysis of the Futures Markets, which really was my interest at that particular time. And then later on broadened it to the financial markets. So I'd say the first half of my career, very much traditional technical work. Somewhere along the line, I made a wrong turn or something, a detour, I guess I'd call it. And I think it was mainly because of my experience in the futures markets, where in futures we would trade in currencies, commodities, stocks, bonds, all that kind of stuff. And I began to notice that, you know, these things, there are relationships between these things, and maybe there's something useful here. So I started to get involved in, I didn't make up the term intermarket analysis. I don't really know who, maybe Martin Pring did. I know he was doing a lot of this at that time. Intermarket analysis, and that is really, I still do a lot of the traditional stuff, but the intermarket has really become the area of my main interest. And that's what I'm going to talk to you about today. And we'll try to talk a lot about the current markets as much as possible. I'm not going to go into a lot of definitions because I assume most of you know something about this already. But I just want to state very simply the term intermarket analysis. Intermarket is really the key. It simply means that all the financial markets are interrelated. David, yesterday morning, talked about multi-asset analysis. All of the markets everywhere in the world are correlated to one degree or another. And as a technical analyst, even though you may be looking at a chart of, let's say, the S&P 500 and looking at the 200-day moving average and all the traditional things, intermarket work suggests you should also be watching what's happening in Germany, or you should be watching what's happening in Europe, or you should be watching what's happening to the dollar, because it has a tremendous influence on what happens in the U.S. markets. Now, the U.S. market is my main concern, but I do follow the foreign markets quite a bit, and I encourage American investors, which is my primary. I write at stockcharts.com. We have a lot of foreign subscribers, but I think it's safe to say the bulk of my audience is Americans. So I always encourage them to look at what's happening overseas. First of all, you should be investing overseas, but even if you're not, because what happens overseas affects what happens in the States. So I'm going to move through these very quickly. Hopefully, there we go. I'm not going to go into a basic explanation of all the relationships. That would be really boring and it would take up all my time. So I'm going to just focus on some of the current relationships that I see going on, and hopefully you'll find this interesting. I'm not sure that I'm going to tell you anything that you don't already know on one level or another, but it may be helpful to kind of put it all together in one spot and see how it kind of all fits together. I do an awful lot of ratio analysis. Other speakers have alluded to this, relative strength analysis. This is extremely important in intermarket work. So we'll just work through. Ratio analysis shows that stocks are outperforming bonds. We'll talk about that a little bit. Stocks are also outperforming commodities. For the last couple of years, that's the first time we saw that. We've seen that in quite a while, and there's a reason for that. And also, U.S. stocks are global leaders, which I'm sure you're aware of at this particular point. We are, at the moment, the strongest stock market in the world for various reasons. And then the last bullet there, the implications of a stronger dollar. Actually, the stronger dollar, it has a lot to do with the previous bullets there. Everyone's talking about the dollar now. Even the Federal Reserve is getting concerned about the dollar, the rise in the dollar, but we'll talk about that in a little bit. I'm going to work my way through the charts. I hope you can see the charts. There's nothing overly complicated on them. I'm not going to show you any technical indicators. It's all overlay charts. Okay, I want to start with this particular chart simply to kind of set the stage. This is the chart of the S&P 500, and you can see that, oops, wrong one, wrong finger, wrong hand. you can see that we had been in a basically, I hate to say a sideways trading range because this was very painful, as you're all aware, for about, we were in a lost decade, basically. And in the spring of 2013, about a year and a half ago, we broke out to the upside. In my view, this was a secular bear market, and we came out of that in the spring of 2013 when the S&P hit a new high, and I happen to be one of those who believe that we have entered a new secular bull market. So that's very good. By the way, we are one of the few markets that has hit new highs, as you're aware. Most global markets around the world have not yet hit new highs. Your market right now is actually testing its old highs here in Britain. It's backing off a little bit. But I want to make the point that that upside breakout in stocks actually set in motion a number of other intermarket relationships. This next slide, I hope you can see it. The numbers, the colors are a teeny bit faded on the screen. But anyway, all it is, it's a simple ratio. As I mentioned, I do a lot of ratio analysis. This is a ratio of stocks, the S&P 500, divided by the price of U.S. Treasury bonds, actually the 30-year bond. And this type of chart is very useful because investors are always, these two markets are always competing for investor funds. So there were certain times you should be in bonds, certain times you should be in stocks. When the ratio was falling, for example, from 2000 to 2003 and 2007 to whatever that was, 2009, obviously bonds were the better place to be. Notice, however, that in 2009 the ratio bottomed. It's also interesting, by the way, this may be just sheer luck, as the professor talked about this morning, that we just may be pure luck, but I find it interesting, drawing two parallel trend lines on that, right? I didn't expect this to work this well. Notice that the second bottom in 2009 bounced right at the lower trend line. I find that interesting. Anyway, so since then, the ratio has been rising, which means that stocks have been outperforming bonds. But it wasn't until the spring of last year, right here, that the ratio actually broke this decade-long downtrend line. That tells me, if I'm reading this right, that this last decade that favored bonds over stocks for various reasons has now shifted in favor of stocks. Now, all these charts, I'm talking about 3 or 4 weeks old. They're not, we have to submit, we had a deadline for submitting these charts. They're all about a month old, but I don't think anything has changed too much. So that suggests to me that we have come out of this lost decade of stocks. Now, bear in mind, I'm looking at the U.S. market. And so I think that for investors, stocks are going to be a much better place to be than bonds over the next decade. And these are very long-term trends. We're talking about secular trends that could last anywhere from maybe 5 to 10 years. Now, this next chart gets a teeny bit more complicated, but it's not that bad. First of all, the brown line that you can see on that, it's another ratio. This is the S&P 500 divided by the divided by the CRB index of commodity prices. This is an index of 19 actively traded commodities. And you can see that, and the green line, as you can see there, is the dollar index. And when I'm looking at currency, I look at individual currencies, but the dollar index is the US dollar against a basket of currencies, of which the euro, by the way, has the biggest weighting. But anyway, so I've just kind of overlaid. And you'll notice that the ratio, well, first of all, you can see that the ratio and the green line tend to correlate. For example, from roughly 2002, when the dollar peaked down to about here, the ratio was falling, which means during that period of time, stocks underperformed commodities. You can recall we had a big boom in commodity prices during that period of time. So commodities were the better place to be. Right here, when the dollar bottomed, right here in the middle of 2008, right in the middle of the financial crisis, the dollar bottomed. I don't know whether it was a flight to safety, whatever the reason, that vertical bar. From that point on, the dollar has been at least stable. It hasn't gone up, it's been stable. It has turned up recently. But since that time, that has put downward pressure on commodity prices. And as a result, since that period of time, stocks have been a much better investment than commodities, and remains very much so today. So one of the reasons for that is because there is an inverse correlation. In fact, the strongest intermarket relationship of all is the inverse correlation between the US dollar and commodity prices. As you know, you can see this just recently. The dollar, for example, this chart's about a month old, but the dollar has hit a 4-year high. Everyone's talking about the strong dollar, that has pushed commodity prices into a real tailspin. I noticed today Brent crude is trading at a 2-year low. The CRB index is at the lowest level in a year. Commodity prices have really come under pressure. There's some good and bad things in that. If we have time, maybe we'll get into that a little bit. So, the direction of the dollar tells you whether you should be in stocks or commodities, and at the moment, stocks. So the bottom line is that over the last decades, commodities and bonds did quite well. Places like gold, for example. Right now, stocks, at least U.S. stocks, appear to be a better place to be. Not that they can't correct, which I think that they're in the process of, but on a relative basis, they are the better asset class. Let's talk about gold. We can't talk about commodities without talking about gold. Now, the green area, the same dollar index, because that's sort of the background filter here. The gold line here, this thing here, this is also a ratio. It's a very well-known ratio in intermarket analysis going back 40, 50 years. It's the Dow Industrials divided by gold, okay? And you can see, for example, during this period of time, the ratio was rising into about 2000. Actually, between 1980 and 2000, stocks did much better than gold. Gold were in a secular bull market. Did I say that right? Yes. Stocks were in a secular bull market, gold in a secular bear market. They reversed trends in 2000. Stocks entered a secular bear market, and gold entered a secular bull market. I hope I'm saying that right. Okay. And you'll notice that, and again, a big reason why the gold did so well was because of the falling dollar. Again, right around here, this all began to change. And notice that right here, this ratio actually bottomed in 2011. I'm going to come back to why that happened. And you'll notice that the ratio has turned up. So over most of the last decade, gold was a much better place to be than stocks, U.S. stocks. That ratio has now turned up. And this, by the way, is like a 10-year, actually it's almost a 13-year trend line. You know, when major trend lines like that are broken, that usually indicates major changes in trend. So that upside breakout in stocks that we started with, the first slide, when the S&P hit its record high in the spring of 2013 and began a secular bull market, in my view, that ended the bull market in gold. Gold is now in a major downtrend. I don't think that's likely to change. Now, you'll notice that although the dollar bottomed here, gold, this ratio didn't actually bottom until 2011. There's a reason why that happened in 2011, and let me bring a third thing in. So let me just recoup. Gold tends to move in the opposite direction of stocks. So the fact that stocks are in a bull market, bad for gold. The fact that the dollar is going up, bad for gold. But there's a third element, and that is this thing right here, which is U.S. interest rates. Now, and this is the price of gold, obviously. Now, I use the 2-year because, although all the focus is on bond yields at the moment, we're going to talk about that, the real emphasis, I think, right now, and where the real strength in the dollar is coming from, is the fact that short-term rates are moving up. Now, they're not moving up a lot, and in fact, I've used a log scale here so that you could see it a little better. I'm not saying it's moved up a lot, but it has moved up. But notice that this peak in in gold right here coincides exactly with the bottom here, okay? Gold tends to move in the opposite direction of interest rates for obvious reason. Gold is a non-yielding asset. So when rates are low, there's really no yield anywhere, gold becomes very attractive. When rates start to move up and people start talking about the Fed raising interest rates, that's normally bearish for gold. So you can see that we've had this, basically short-term rates have been creeping up now for almost 2 years. Again, not a lot, but you can see the trend. And you notice gold. And gold looks like it's in a looks like almost a descending triangle. I think gold's going to break down here even more. Okay, so we'll talk about that a little bit. So gold has a lot going against it, and gold is sort of a proxy for commodity prices, 2-year yield. We'll talk about that just a little bit more. So that's just a quick run through some of the basic intermarket relationships that I see going on in the States, and how, for example, asset allocation, stocks, bonds, commodities. And you can even go further with that. You can break fixed income down into various categories. You can break stocks down into various sectors. For example, certain sectors of the market do well when the market's rising. For example, just recently, I'm diverging here just a teeny bit, but just recently we've noticed in the States the two strongest sectors in the market have become utilities and consumer staples. If you look at the relative strength, this is over the last month or so. So normally when you see money flowing into consumer staples and utilities, that's normally a sign that traders are turning very defensive. In fact, one of the weakest sectors in the stock market have been consumer discretionary stocks and industrial stocks. They are economically sensitive groups. So we also check these things. So when you see that going on beneath the surface, and by the way, the reason utilities are going up is because bond yields are going down. Consumer staples are very highly correlated to bonds. So even within the market, there are layers and layers. But anyway, I don't want to dwell on that too much. I want to make sure I finish on time here. The international implications of a rising dollar. First of all, a rising dollar tends to favor U.S. over foreign stocks. There are reasons for that. Also, I want to show you that we are at a critical juncture right now in the global uptrend. I'm not sure we can call it that anymore. EFI and EM iShares are testing major overhead resistance barriers. Remember, I wrote this a month ago, so they've kind of rolled over a little bit. And also, I want to talk about something that maybe this is, maybe you don't need to hear this, but because you're here in Europe, but writing for an American audience, I always point this out. Euro weakness hurts stock ETFs, and I'll talk about that in a second, what I mean by that. Let's go to the chart. Sort of the same flavor on the chart here. The green line, oops, can't tell my left from my right. There we go. I'm in London. I get confused left and right. People drive on the wrong side of the road. I'm very confused. This is the dollar index, and you can see the same basic idea and coming up. Now this, again, it's all ratio. It's all ratios. This is a ratio of the S&P 500 dividing by the MS World ex-USA index. So it's an index of foreign stocks. I think it's mainly developed stocks, maybe some emerging markets in there, but I'm not totally sure. But anyway, you can see that, again, the correlation to the dollar. From this area here, from let's say 2002 to roughly 2008, when the US dollar was weak and foreign currencies were strong, notice the ratio falling. When the ratio is falling, that means that the US market is underperforming, or your markets are outperforming. Let's put it that way, put a positive spin on it. However, since this point here, and you see the vertical line, when the dollar hit bottom, and it's been slightly moving sideways with a slight upward bias, from that point in time, the ratio has been, the US market has been the strongest market in the world, okay? By the way, and that remains the case. Now, again, I must admit I do get into some fundamental stuff. For example, why would the dollar be stronger? Well, because, as I'll point out, interest rates in the States are higher. Our economy is, usually when you have a stronger currency, it means that interest rates are a little bit higher or about to turn higher. The economy is a little bit stronger. So there are a lot of reasons for that, which I don't always get into too much. But anyway, that's that. By the way, there's another corollary, and maybe this isn't quite as strong, but I've also noticed this, and that is that when the dollar is weak and foreign stocks are rising faster, emerging markets tend to be leaders. And in this area here, when the dollar is strong and is outperforming, doesn't mean foreign stocks are going down. It just means that the U.S. is going up faster. When the U.S. market is outperforming, emerging markets tend to be the weakest. In other words, developed markets tend to do a little better than emerging markets. And I think that has to do with commodities. Well, there's a lot of reasons. A lot of the emerging markets are tied to commodities, as you're aware. So they tend to do better when commodities are strong, and recently, as you can see, they tend not to do well when commodities are weak. Also, rising dollar and rising interest rates are generally not good for higher yielding parts of the world like emerging markets. But anyway, I don't want to get into the weeds too much, but that's one of the side effects. Now, in intermarket work, I always try to blend intermarket principles with just traditional charting. Although I'm not doing a lot of traditional charting here, I really, believe me, I do it. I just pointed out that although the U.S. market, let me show what this is. This is simply the S&P 500, and you can see we're trading at record highs. Now, if you're trading the S&P 500, and you're just looking at that and nothing else, you say, well, we're going to the moon here. I mean, there's no more resistance. I mean, we're at all-time highs. There's no resistance on the charts anywhere, so no reason why it shouldn't keep going up. Okay, that's true if you're just looking at that. But if you look around the world, you'll see that there are certain other things going on. Now, the blue bars here, that is the IFTA shares. Now, I don't know if I've already said this, but I use ETFs I won't say almost exclusively, but I use them quite a bit. And I'll talk about that a little bit more. IFTA, Europe, Australasia, and the Far East, okay? And you'll see that this hit a peak in 2007. They're moving in the same direction. Notice they do move in the same direction, okay? But notice that I published this chart actually about a month ago on our website. Notice that we are right up against this high. Now, as any chartist knows, whenever you're in a major uptrend and you reach a major peak like this, very often, it may go through eventually, and I think it will eventually. You know as well as I do, especially if it's in somewhat of an overbought condition, there's a good chance for a pullback. People are going to take profits at that. You're going to get a pullback, maybe not a big one, but a pullback, a correction, a consolidation. You're going to see profit taking. The reason I pointed that out was simply to be careful here, because if the index of foreign developed stocks starts to correct to the downside, and this is a logical spot for that to happen, that's going to cause some problems in the U.S. market. Maybe not big problems, but it may stall this advance. And by the way, as you're probably aware, the real culprit here is you guys right here, Europe. Europe has been the real problem. Far East, not so much. But most of the weakness has been in Europe. Now, I don't know exactly where this is. It's probably down here somewhere. But as you know, IFTA shares have sold off. Okay, but the whole point was simply to be a warning that to be careful in the U.S., that this is a good time for a global correction. And this is a chart of emerging markets, EEM. And you'll see the same thing. Now, this chart goes back again to 2007, and nothing fancy here. Just draw a trend line. You could do this with a pencil and a ruler, which we used to do. And my only warning to you is if you're going to draw trend lines on charts, make them thick trend lines, big, bold trend lines. Markets they don't respect thin trend lines. And also make sure you use very bold colors. Don't use yellow or pink or magenta. Markets don't respect those colors. Use purple, black, or in this case, a nice thick red line usually works pretty well. Market's afraid of that. But anyway, notice 2007, this is just first year technical analysis, right there. And I was just pointing this out that I thought maybe this is a coincidence, but at the exact point that the IFTA shares are up against major resistance, so is this. So it simply means that the overall chart looked bullish to me, longer term. But on a short to intermediate, and in the longer term we're all dead, so we live in the short to intermediate term, this is a likely spot for this to run into problems and start to correct, okay, which we have done. So looking at the latitude charts suggests that we're due for some kind of a global pullback, global correction, not necessarily a terrible bear market, but a correction. And since the U.S. market is correlated to these markets, this is probably going to cause some problems in the U.S. Now, these next two slides, you may very well be aware of this, but I want to point it out anyway. I always have to point this out to American investors who maybe aren't as sophisticated as you people. Since most of us who look at foreign markets use the ETFs. One of the reasons, by the way, we look at the ETFs so much is because they trade during the day. It's a little harder for us to track your markets intraday, but the ETFs do trade all day. You notice now, let me just point out what this is, if I can figure it out. The bars here are the DAX. Now remember, this is a month old, okay? The DAX and this kind of purplish line here, these are Germany iShares, EWG, okay? And you see they generally trend in the same direction. You notice they peaked here in June, they sold off, and then they both rallied. Okay, now they have both weakened since then. But anyway, the point is, look at this rally in the DAX. Look at how much higher this is and how much lower this is. And I wanted to explain, in fact, this got back above its 200-day moving average, which I'm not showing here, and this was still well below it. And I got questions from some of our subscribers, well, why is the performance so different? You're probably aware of this. This is purely currency. In other words, all foreign markets like Germany, is quoted in their local currency. I assume you know this, but I want to point out that anyway, because it does have a bearing on chart analysis. This is quoted in the euro. All ETFs are quoted in US dollars. They're traded in New York. In fact, I think they're traded on the New York Stock Exchange. They're traded in New York. They are quoted in US dollars. That makes a big difference. So when the dollar is strong and the euro is weak, let's put it this way, the one quoted in the weaker currency will be stronger. The one quoted in the stronger currency will be weaker. Does that make sense to you? The one quoted in the dollar will be weaker. So it's the fact that the euro is so weak and the dollar is so strong is the reason that this is underperforming. Now, let me give you a better example. This is a little more dramatic, and I hope you can see this. Again, it's all relative. Everything's relative. The blue line there is a ratio, simple ratio of the EWG, Germany iShares, divided by the DAX. And again, this goes back, the dates are actually here, September the 8th. So almost exactly a month ago. And by the way, I apologize, the charts, the dates aren't there along the bottom, but I double checked it. This is about a 2-year chart. This goes back to the beginning of 2013, okay? You'll have to take my word for that. And the green area is the euro. And you'll notice it's almost a perfect correlation between the two. What it simply means is that when the euro is rising, the EWG will outperform the DAX. And that was this. That was 2013, okay? The euro is strong. The EWG, which is quoted in dollars, will be weaker. Right around here, right around May of this year, you can see when the euro started sliding. From that point on, the EWG has underperformed. And that's because the EWG is quoted in dollars and the dollar was soaring, so that tends to push down its value. So if you're an American investor, I tell them, look, if you're going to invest in anywhere overseas, first of all, the ETF gives you a much better sense of your profits and losses because it immediately filters the currency translation into it. You have to look at the currency. If you're buying stocks in Germany or Japan, for example, you're also buying the currency. So if stocks are falling, you're not only going to lose on the currency, you're also going to lose on the stocks. Okay. By the way, I'm going to come back to this later, but I'll just make a point here. There are a new group of ETFs that have come out, exchange-traded funds, that hedge out the currency. In fact, I just wrote an article recently on one, and there is one very popular one for the Eurozone, HEDJ, Wisdom Tree. I don't know if you're familiar with Wisdom Tree. They have a lot of very innovative ETFs that hedge out the currency risk. HEDJ is the Wisdom Tree Europe hedged stock fund, something like that. If you were to look at it, it's up here. It's falling, but it's not falling nearly as much. It filters out the influence of the currency. I just want to point this out. Maybe you're already aware of this. Maybe there's no need to do this. Unfortunately, not unfortunately, I have also found that very often the ETF does tend to lead the cash index, so that's not necessarily good news. I know your DAX is down here testing its lows for the year. The ETF has already broken it by a big margin. I think it's trading at the lowest. That's not necessarily a good sign. Okay. I'm going to come back to that. I'm going to come back to that a little bit later and show you how that works out. Now let's talk about interest rate. And I'll apologize if this sounds like fundamental analysis, but we're sort of blending the two. And bear in mind, everything I'm doing, I'm looking at charts. I'm not really talking economics. I'm just looking at charts. Okay, falling German bond yields have contributed to lower, that should be yields really, bond yields. We'll talk about that. Also, we'll talk about 2S, the implications of the U.S. 2-year yield hitting a 3-year high. And also, this last one, using an ETF to hedge the negative effect of a falling yen. Okay, so let's get through this. These are all very simple charts. This is a chart of the 10-year yield in the States, and this is the 10-year yield in Germany. I'll just point out that notice the close correlation between the two. And by the way, this is a correlation coefficient along the bottom. They have a correlation coefficient of almost 90%. In the States, we may have heard this. One of the speakers talked about this yesterday, I think. In the States, first several months of this year, there was a tremendous amount of confusion. I was confused myself, along with everybody else. With the stock market going up, and the U.S. economy strengthening and the Fed tapering, everybody thought bond yields were going to go up in the States. Remember, we had the big run-up last year. Everybody thought, and everybody was wrong, including myself, for a while anyway. No one, the bond market, falling yields are indicating economic weakness. Rising stocks are indicating economic strength. That really, from an intermarket perspective, it didn't make any sense. If you're looking at the U.S. bond market all by itself, you're an American investor or whatever, and you're looking at bond yields all by themselves, you're saying, why in the world would I want to put money into a 10-year treasury that's yielding 250? Right now it's yielding actually 230, believe it or not. Why in the world? These are historically low levels. There's no reason to do it. And you'd be absolutely right if the U.S. was the only country in the world. But if you look overseas, it makes a lot more sense. While we are, by the way, these yields have since come down. Yesterday, this hit a new low, 230, and the German Bund actually is down to 90, which is, someone told me yesterday, a 500-year low. Well, you guys have more history than we do, so 500 years, that's pretty good. Anyway, so I began writing about this several months ago. I says, the reason that the U.S. bond yields are coming down has really very little to do with the U.S. It has to do with Europe. It has to do with Japan. Just like stocks are highly correlated, global stocks, global bonds are highly correlated. Look at these two, okay? And the U.S. yields are at historically low levels. But if you have to make a choice between, let's just stick with round numbers, if you had to make a choice between buying a 10-year German bond at 1% or a U.S. bond at 2.5%, which would you take? Of course, you go for the U.S. You have a higher yield. Compared to Germany, we're a high-yielding country. We're like an emerging market, Japan is 0.5%. So compared to Japan, these are two areas that are battling deflation, as you're aware. Although I haven't noticed any deflation in London the last week. Everything's so expensive. I'd hate to come here when you're having an inflation problem. But anyway, where was I with that? Everyone around the world is battling deflation. So the fact that yields are so much lower in Europe, so much lower in Japan. In fact, recently, the only country whose yields were even comparable to ours are right here, the UK. And then they slipped a little bit below it. So UK rates are somewhere around the US. So they are considered the two strongest markets in the world at the moment. Although you wouldn't know it looking at the stock markets. So there's a lot of deflation going on. So the only way you can understand this decline in bond yields is to look at what's going on overseas. And as long as the Eurozone is fighting deflation, as long as Japan's fighting deflation and Japan's in the middle of quantitative easing and you guys are getting pretty close to it here, it looks like it's highly unlikely these are going to go up much. It's just not likely. So what's going on here is acting as a drag on that. So the whole point of that is simply you can't look at the U.S. market in a vacuum. And I'm always preaching this to, in fact, when I first started doing intermarket work years and years ago, it was not well received by the technical community. They did not think that this had any place in an MTA conference or I won't blame IFTA, you weren't even around then. An IFTA conference. Now it's considered the branch of technical analysis. But it was so frustrating talking to an audience of American analysts. They had no interest whatever in what was going on overseas 30 years ago. No interest whatever. Now, of course, they follow it very. In fact, when you turn on Bloomberg now or CNBC, they follow the foreign markets just about as much as they follow. And so I do get a kick over coming over here and watching your local markets to see how much, well, obviously you cover your markets here very extensively. I get a kick out of that. Anyway, let's move on. Let's talk a little bit, this is the dollar. Although the focus is a lot been on long-term yields, this is really where the real interest is. These are short. This is the 2-year yield in the U.S. I'm not quite sure why I put it in red, but you notice that this has been moving up. The dollar has been moving up. I think this is really the reason that the dollar has been so strong. This is the 2-year. This is the one that bond yields are influenced by inflation, deflation, foreign yields, whatever. This is more influenced by Fed policy. And as you know, the markets anticipate. So this is anticipating higher yields in the U.S. And the Fed being one of the first. There's a race going on apparently between whether the UK or the U.S. are going to, I don't think anybody wants to do it now, But notice a 3-year high. And of course, that's lending support to the dollar, which is moving up. Meanwhile, the German 2-year yield is negative. I think most of the Eurozone is actually negative at this point. So you have US yields moving up. You have German yields negative. Obviously, this is a much better place to be. And that's why the dollar has been so strong and this has been so weak. By the way, over the last, I know Larry Berman before me mentioned the Fed the other day, and I don't want to get too current because I'm not sure what's going on at the moment. But just this last Thursday, the Fed came out, and everyone thinks the Fed is getting ready to move. They came out with an incredibly dovish statement in which they expressed concern about the slowing economy. They expressed concern that the rising dollar may act, because we all want to see more inflation. We have a little more than you do, unfortunately, or fortunately, I should say. They're concerned that the rising dollar may actually push US inflation back down again, maybe even toward deflation. They're also concerned that the rising dollar is going to have some negative effects. So the dollar corrected a little bit, and this pulled back a little bit. I think it's down here somewhere. So we're getting a little retracement. But anyway, so these are things worth keeping an eye on. And since we're speaking about currencies, I want to come back to that just a little bit. Obviously, when the dollar's going up, most foreign currencies, I can't think of any foreign currency that's going up at the moment, but I might be wrong, that certain currencies get hit harder than others. So again, let's continue this. When let me go on with this. The brown bars here, that's the CRB index, okay, all the way down. The green line, that is the Australian dollar. The red line is the Canadian dollar, okay? When the US dollar is going up, obviously foreign currencies go down, and commodity prices go down. So currencies that are tied to countries that are natural resource producers tend to get a double whammy, which is they're not only getting hit by a rising dollar, they're also getting hit by falling commodity prices. And two of the worst performers were these two, the Aussie. In fact, this chart was done a month ago. They're all down around here somewhere. The CRB is testing its lows way down here, and I think these two are down here as well. So that's another thing. They call commodity. I think the New Zealand currency is just hit a record low or something like that. I even read this morning, the Russian ruble's at an all-time low against the dollar, but a lot of that's geopolitical. But it also, I saw on Bloomberg this morning that Russia's also being hurt by falling oil prices, which are just collapsing. So anything tied, even Brazil is affected by it. Any currencies tied to commodities are being hurt. Okay, let's move on. I'm keeping a close eye on the clock here because I want to leave a little time for Q&A at the end. I think this is the last chart, at least I hope it is. And I want to come back to this idea of the Wisdom Tree ETF hedges out the negative effect of a falling yen. David touched on this yesterday morning about the inverse correlation between Japanese stocks and the Japanese yen. He plotted them so that they would go in the same direction. I'm showing them the way they actually are. The green line there, that is the Japanese yen, as you can see. And I'm going back here to the end of 2012 when all this started, when Abenomics started to come into play, when the new regime came in to Japan, and they wanted to battle deflation. You know, Japan's been in deflation now for almost 20 years. Part of the problem with that was the yen. The yen's been one of the strongest currencies in the world during that period. And the way you battle deflation is to lower the currency. So that was it. And you can notice that from that point when the yen started turning down, Japanese market became the strongest. It went from one of the weakest markets in the world to one of the strongest. And then notice that, again, a combination of intermarket with this, forming a nice bullish triangle here. And then about a month ago, the yen hit a 6-year low, and this thing broke out to the upside. Now, we've retraced a little bit since then, but at least you can see. And it's amazing to me how these things happen. They happen so coincidentally. And also the fact that, again, one other little example of this is if you see a bullish pattern like this, now I think you would all recognize this as a triangle, okay? And you know a triangle is usually bullish when you're in an uptrend. So if you see one side here and you say, this looks bullish to me, and you know that this thing is inversely correlated, that automatically makes you bearish on the yen. So very often you'll be looking at one market, and one of the markets may not be telling you much. Yeah, I'm confused about that. But the other one may be giving you a very clear pattern. And that will tell you what the other one's going to do. So anyway, now let's get back to Wisdom Tree. As I mentioned, now the yen has lost about 30%. That's a lot of yen, 30% since the end of 2012. And the Japanese market's up about 70%, I think, during that period of time. Okay, now if you were an American investor, or maybe any investor, and you would put money into this market, if you had put it into the Nikkei, you would have done well. If you had put it into the EWJ, which is another very popular ETF traded in the States, EWJ, Japan iShares, that is traded in dollars, okay? You would have made about 30%. If you invested in this, you would have made about 60%, double, because this ETF hedges out the negative effect of the falling yen. So you're getting the benefit of rising stocks, and you're not being hurt by the falling yen. This has become the most popular vehicle in the States for trading the Japanese market, okay? So there are two lessons there. If you're going to trade this, got to look at this and make sure you hedge this out. And by the way, the difference in performance between the two is purely the currency. I mentioned that this is up over 60%. The EWJ was up about 30%. That 30% difference between the two is accounted for by the 30% drop in the yen. Okay, so that's just a little something to keep in mind. We're doing pretty well. I'm just about done. Picture of my 3 books on Intermarket Analysis. Notice I didn't put my picture on the last one. Not quite sure why that is, but the reason I'm putting it up there is I've written 3 books, and I don't think I'm going to write any more. I think I'm too old to write another one. But the main thing is the headline there. When I first started writing about intermarket work, I don't know, 30 years ago, it was very hard to implement a lot of these strategies because the vehicles weren't there. Now with ETFs, I mean, my God, you can trade the US market, you can trade big caps, small caps, you can trade sectors, you can trade foreign shares, trade fixed income currencies, you can do it all. It makes it very easy, so it has revolutionized intermarket trading. I think it's one of the reasons it's become so popular because, first of all, the presence of ETFs make it extremely easy to track these things. And maybe even more importantly, it makes it extremely easy to implement them. So you can, it's very easy for me, with maybe 15 or 20 ETFs on our stock chart screen, I can follow everything that's happening everywhere in the world. So ETFs, but there are, as I mentioned with the currency thing, there are certain things you got to know about the ETFs. And then let me wrap it up with this last slide, what intermarket analysis does and what it doesn't do. First of all, as you've noticed, I think it bridges the gap between fundamental, economic, and technical analysis. If I were giving a talk here to a room full of economists, I hope there were none here today. I'm just kidding. I don't think they would have any problem, because I'm not talking about head and shoulders tops. I did talk about a triangle, but I'm not talking about head and shoulders tops. I'm just talking about basic economics here. And I'm just using the markets to point these things out. I don't think an economist would have too much of a problem with that. It also combines all global markets into a unified and coherent whole, as I've tried to demonstrate just in a little way. And also, I think maybe more importantly of all, it adds a new dimension or another layer to traditional technical analysis. I have nothing against traditional technical analysis. I still use it. I didn't show it to you today because there just isn't time. I still look at all the charts and all the indicators and all that kind of stuff. I'm simply suggesting I don't think you can stop there. I think there's more. So if you're trading the US market, you have to know what's going on with yields. You have to know what's going on overseas. You have to know what's going on with the euro. You know what I'm saying? It all fits together, that kind of stuff. So even if you don't trade the other markets are offering you an enormous amount of information. And once you understand a few of the basic principles, it's really not that difficult. Okay, the trends are usually pretty easy to spot. You just have to make sure that you see them. And I think, Max, how am I doing? I think I actually have some time left over. Oh, good.
There's a question back there.
So I have a question about European underperformance. As you didn't show a long-term chart, but I'm sure you're aware that we are at an all-time low of for European stocks versus US stocks if you express everything in the same currency. Do you think we are going to break out of what usually was a range, or do you stick to the mean reversing properties that we usually that have been in force over the previous 20 years?
I think I got part of that. If you want my views on the markets, I could have shown you a lot more charts, but I didn't. I chose not to do that. I do think that the European markets are leading the rest of the world lower at the moment. The Eurozone in particular is quite weak. I mentioned there's an ETF, EZU, which is an ETF of the, 15 or 18 EMU countries. That's trading at a 12-month low. I happened to look at, and I mentioned the German, I happened to look at the German market yesterday, and it looks like it's testing a neckline of a head and shoulders top. There we go, technical. Looks like that's getting ready to break down. I think the FTSE, which is the strongest market in Europe, just hit a 52-week low, I think. So it looks to me like the European markets, I think this is a correction, basically, to be honest with you. I still, as I said, I think stocks are going to do a lot better than bonds in the next, but we have a deflationary problem going on. One thing I find a little interesting, maybe ironic, and I'm not sure this is answering your question, but I understand that the Eurozone, the ECB, is trying very hard to fight deflation. I understand that. And the way to fight deflation is to lower your currency. But by weakening the euro, they have strengthened the dollar. And by strengthening the dollar, they have weakened commodities. And the falling commodities are increasing global deflation. You get that? Yeah, commodities are plunging. The price of oil is plunging. Crude Brent is at a 2-year low. The main reason for that is because the dollar is rising. And the main reason the dollar is rising is because the euro is falling. The euro has 57% of the dollar index. So in a way, by lowering the euro, the ECB is contributing to global deflation. I just find that an interesting thing. So it looks like, and now with the dollar so strong, they're beginning to worry about maybe some deflation in our country. So we may be facing a deflation. I thought we had come out of this. I thought the deflation scare was the last decade, and we had come out of it, and it looks like we're right back into it again. Deflation's a lot worse than inflation, because there comes a point where the central banks can't do anything. So we're going to have to ride this out. It's going to keep interest rates lower for a longer period of time, which may in the long term help stocks. But at the last statement I wrote, the last article I wrote last week, we were looking at the US markets, which were all coming down and testing 200-day moving averages, and there was a big debate. Is this just a pullback or the start of a correction? I kind of leaned toward the latter, but I said ultimately it's going to be determined by what happens in Europe. If the European markets can pull out of their tailspin, then we'll probably be okay. If they don't and they keep going lower, then we're going to probably go lower as well. One final story, and I think we'll, the last time I was in Europe was January 2008. I gave a speech in Switzerland, Zurich, I think it was. And we were just beginning to go into a tailspin in the States the previous 3 months. And I kept reading about how Europe was immune from this because they had decoupled, which is a word I hate. And I gave a speech, a very depressing speech, and I said, I'm sorry, but there's no such thing as global decoupling. I said, if we're going down, you're going down with us. And now I read just the opposite. I've been hearing over the last week or so that Europe's got problems, but the US is decoupled from Europe. So it's just the opposite. So I said, well, if Europe's going down, we're going down with Europe. Maybe not as far. But anyway, I think they're all interrelated. I'm not sure that answered your question, but I gave it a shot.
John, going with that theme, and you're stating that we think that the U.S. markets are in a new secular bull market. If the European markets pull the U.S. markets down, does it seem reasonable that we could retest the breakout from spring of 13?
Actually, interesting. The first slide I showed was the, if I understood your question, how far down would we go? On that breakout, of the first chart we showed, the S&P 500 breaking out last spring to an all-time high. Normally, if we get it, it should stay above that. So that the 2000, 2007 high should be the new support level. We could pull back 20% from here and still be at that support level. In fact, I wrote that earlier in the year. I thought we were going to get a bigger correction sooner. And I said, we could go down 10, 15, 20%, and it wouldn't affect the long-term uptrend. If we go more than 20%, then we'll have to rethink it, but I don't think that's going to happen. So we haven't had a 10%, I know I'm talking more about the States, but that's where I spend most of my time. We haven't had a 10% correction in 3 years. At the very least, we're due for that, maybe 10, 15%. And if the dollar stays strong, I don't think we'll correct as much as you because we'll do better, but I think we will correct. I'm thinking maybe 10, 15%, and I think that'll create a good buying opportunity. I think that'll create a good buying opportunity because I think we're still in a secular bull market. And we're in a period of seasonal weakness right now, October. As you know, most bottoms are formed during October. We're also in a midterm election year, which is generally very good for the markets. So I'm hoping for a deeper correction here, a better buying opportunity. I think things may start to get better from there, but a lot will depend on what happens here in Europe.
We'll just squeeze in one more question because I know Feng's been waiting patiently.
Okay, actually I have 2 questions. Is that all right? Well, the first one is, I noticed the intermarket relationship has been changing for some markets, as with the case of the Japanese yen and Japanese equity market. As you pointed out, it has been possibly correlated over the past 10 years, but not necessarily the case before, say, 10 years, like before 2005. And also noticed like a paradigm shift change in terms of the relationship between the US bond and the US equity market since the global financial crisis. My question is, are there any other, say, intermarket relationship changes over the past few years that really stands out to you? My second question is...
I thought that was the second.
We only
Okay.
have time for one question.
Can I take those? Let me try those. If I understood what you said, the relationship between the yen and Nikkei, that actually goes back quite a ways. Since 1988, well, you know, Japan peaked in 1990. During this period of deflation, when Japan was the weakest market in the world, the Japanese yen was actually one of the strongest currencies in the world. So nothing has changed here. The fact that the yen is coming down, and the inverse, it does come and go, but it does hold up over time. It's a very export-oriented country. The other thing about the changing, you're right, the relationships between bonds and stocks have changed. That's one of the reasons I wrote one of my books. I wrote, in a deflationary environment, bonds and stocks generally move in opposite directions. Now, we haven't seen that the last few years, but I think that's mainly because of the Fed. We're not in normal. If we were in a normal environment right now, I think yields would be higher, okay? But the Fed, as you know, has kept rates. We don't have a normal bond market at this particular point. And the reason, just at this point when the Fed is basically leaving the field, our rates should be going up. The rest of the world is just going into quantitative easing, so that's keeping yields low. So I think that's very artificial. And I think, but you're right, the relationship has changed, but I think we know why. But I hope at some point in the future we'll get back to a more normal environment. And I think that's it.
Thank you,
I
John.
think I answered that.
I think we all know that when the US sneezes, the rest of the world often gets a cold, and down in Australia we normally get the flu. And the other thing is, I know my mistakes I'm making in trading now. I've got to get rid of that pink trend line.
Red. Oh,
I'll make
pink.
it red. Thank you very much for a very informative speech.